you're all familiar with Aditi, but I'm going to introduce her regardless. She's a director on the board of DSP Investment Managers. She heads sales, marketing, e-business, and is also on the executive committee. I'd request that all of you just mute yourselves unless you're Aditi, and you can always send your questions in on the chat to get a chance to have them answered. She'll make her presentation, but then do feel free to ask whether it's based on that or even anything else that's on your mind with regards to finance and investing. Aditi is incredibly passionate about the digitization of the financial sector. She's been instrumental in the launch of all of DSP's digital platforms, including its investment, education, and corporate and distributor platform as well. She's focused on the future of investment management as well as the distribution, and is therefore heavily also into the sustainable growth of fintech, giving you a sense really of all that she's got her hands in when it comes to her role. And she also leads financial wellness initiatives at DSPIM and was instrumental in launching Winvestor, a special initiative aimed at empowering women with confidence and financial knowledge to plan for their long-term economic security. And we interact a lot with Aditi and her team at Winvestor, and they've done some fabulous work with regards to some research in the field, reports, talks with women, and really empowering them to take control of their financial security. She's a tough taskmaster. She believes that leadership is about empowering, trusting, and listening to people. When she sets her mind to it, she makes sure that she achieves what she sets out to. Aditi, thanks so much for joining us. Now we have this presentation. Urjita, if you can hear me, you have it as well. So Aditi, you want to start with trying to roll it out while you're speaking? And
sure. Great. Can we go to the next slide? Okay. So I want to start with this. I want to ask everyone, do you feel financially independent? When I ask this question to people, and especially if they're earning their own money, women say yes. Of course, I feel financially independent. It's my money, I'm earning it, and I'm independent. When I ask them, do you actually invest your own money that you are earning? And only, I would say, 5% of the room really puts their hands up and says that that's what they do on their own. And then I ask them, now, do you really feel financially independent? And most people, don't put their hands up. So even the people who felt financially independent realize that because they're not investing their own money, they don't have control to the very end of their money. And if they need to maybe make a larger expense, they still need to ask their husbands or their fathers or their brothers whether they even have that kind of money in the bank or in their investments, because they don't even know. And so we're here to encourage you, help you, and give you the confidence and maybe some knowledge to start making your own investment decisions so that you feel truly financially independent. Next slide, please. Next slide. I think you can just do page down and you'll get to the next slide. But anyway, this is fine. So why bother, why bother learning about investing? Why bother, right? So here are the few reasons. It's your money, you've earned it, or you've inherited it, right? And please remember today, the probability of a woman inheriting money is much higher than it was in the past, because the rules have changed. Even if someone dies without a will, everything would go to the eldest son. Now, it has to be equally distributed amongst this, the children as well as the spouse, the living spouse. So, chances are you may actually inherit this money. Of course, women start families, so they take a break from their job. And, even if you're earning money and you feel financially independent, you feel a bit nervous to, take time away from your job if your children need it. And you get nervous about it because you're not getting a steady stream of income. But well, if you plan for it, you can get some passive income with your savings that you have invested. And so that's the second reason that's unique to women. Third thing is, unfortunately, we have relationships that break up, and women usually are the recipient of alimony. Men can also be recipients, but in India, usually it's the women that are recipients of alimony. And so, you should know how to invest it so that today your lifestyle remains the same after you get, unfortunately, if you've gone through a divorce. And then, of course, dealing with loss. Sadly, women do outlive men statistically. Also today, life insurance has really penetrated. So for a woman to be the beneficiary of a life insurance at some point in her life is quite high. And so she will, get that sum of money as well, and she needs to know how to invest it so that she can feel financially secure. Next slide, please. You can just, yes. Another big reason we all need to invest. It doesn't matter if you're a man or a woman, but there is something called inflation. And unfortunately in India, it has ranged, between 4 and 6%. Like in developed economies like America, etc., it's like 2% or less. The whole idea is that we have to invest so that our rate of return is higher than inflation. Otherwise, what's the point? And look at what inflation is. We've taken inflation at about 6% on average for the future. So today, if education for your child is 8 lakhs, after 10 years, it's going to be 21 lakhs. Sorry, for education, we've taken it at 10% because they said that education inflation is even more than basic inflation. And same with health. If today it's 5 lakhs, in 10 years, your health is going to be, the same health bill is going to be 13 lakhs. So chances are that you have to beat inflation so that your rate of return is more than inflation so that you can actually pay your expenses and actually build wealth. Otherwise, what's the point? Today, rate of return, for example, in, I went to fixed deposits, just about curious to look at fixed deposit rates in Citibank. Now, Citibank is a safe bank, same as HDFC. I'm not going to some random, community bank or something like that, or cooperative bank. There, the fixed deposit rates were 3% for 1 year. And inflation is at 6.9%, the latest inflation. Albeit it could be temporary because of, the price of food had gone up during, this whole lockdown period. But still, 3% in the bank and 6.9% inflation. I mean, we have to be smart. We have to get into instruments that are going to beat inflation in the long run. Otherwise, you're not going to make wealth. Next. So when it comes to investing, where are women? Do they understand these concepts? Do they actually make their own investment decisions? Well, we actually did a little survey this was last year, and we found out that only 33% of the women make their own investment decisions. The rest of them dependent on their husbands or their brothers or their fathers, and they didn't have the confidence or the knowledge to make their own investment decisions. So girls, we need to up that number, and guys, we need to encourage our mothers, our wives, our girlfriends, our sisters, all to start making their own investment decisions because this is dismal. Can we go to the next slide, please? And as women, one thing that we know is, we love to shop, we love to spend money, but do we actually know what our expenses are every year? Do we really know that? Or every month, what are my expenses? Even I didn't know that. And once I made this Excel spreadsheet and I was like, really? This is how much I spend? Do you know how much you're spending on your needs? What are your needs? The basic, groceries for your house, your electricity, your gas bills, petrol for your car, if you travel by public transport, those are your needs. Your wants are your entertainment, your extra shopping, just the fun stuff. And of course, you must spend on that. And then you need to save. What are your savings? And in which order should we go? Should we maybe do, needs first? Yes. Can we do savings next? And then wants later? And if we go to the next slide, it gives you a general idea. This is what, people have said, that generally you should 50% of your should go on your survival or your needs, 30% on your wants and your lifestyle, and 20% at least should be put away for savings. So for future, you have money, you grow your wealth, save for retirement, which we'll talk about later, you save for emergencies, and that's very important. And guys, from that 20%, we'll talk about this also, that there are a few other things that you all need to think of, like insurance. Can we go to the next? Exactly. So first thing you need to do, how do you start? How do you think about this? So in the savings pile, we have to take health insurance. Okay, girls, health insurance, most people don't have. And I mean, my mom-in-law's friend, I'm going to give you a very recent example. My mom-in-law's friend, she's over 70 years old, abroad. She wants to be as independent. She's not earning any money anymore. She has a flat that she's given out for rent, and she's staying in her, her daughter-in-law's house or something. And she's getting the rent from that flat. And that flat, she says, that rent is my income, and I'm fine with that. Guess what? She got really ill. And when, someone who suddenly has to face a medical emergency, it's very, very tough at that age when you're facing a medical issue, and suddenly you need money and you don't have health insurance. These are things that you don't realize when you get old, or even suddenly you're just going to need it. So please invest in health insurance, invest in yourself. Same thing for life dependence. As in, like, if you have people that are dependent on your salary. Now, if you're single or you don't have anyone dependent on your salary, your husband's earning, you're earning, you have no children, you do not need life insurance. Please do not invest in that. If you have people dependent on your salary, you need to get life insurance, and please get something called a term insurance. There's something called a ULIP, which is a unit linked investment plan. That is not what you want to get, because those are very expensive. They have a lot of negatives. But a term insurance, which is cheaper, that is something that you need to put your money in. After that, of course, you figure out what your, we've discussed this earlier, you should know what your needs are, not just what your wants are. Of course, after that, you should have some money to have some fun. Understand what your risk appetite is. What is your risk appetite? It means, if the market goes down 50%, how will I feel if I know that eventually in 5-7 years it's going to go up and I'll make money? But how anxious will I get if the market goes down a little bit? So there are different instruments for different people. Some people say it's okay, I know the market, one day I'm going to double my money in 7-10 years. I'll double my money. I know that. I'm very confident. And so if it goes down 1 year, 30-40%, I don't care. So that means that's a person who's willing to take high risk. Are you that person? Or are you someone says, listen, I don't want to lose any money at all, ever. But please also remember then your return may not be so high because you can't take any risk. Someone says, okay, chalo, I'm willing to live with 10-15% down 1 year. When I know that eventually, because, I'm investing for 5-7-10 years, I know eventually that, I'll make some money. So you need to assess your risk appetite, and a good financial advisor will ask you questions and help you to assess that. Okay. The second part of assessing your risk is to understand, if you can even take the risk. Now, if you are the only earning member of your family and you have, 3 people dependent on your income is low, And you like, yeah, I don't care if I want to invest all my money. I don't care if the market goes down 50%, but I know in 10 years it'll go up, I'll make money. But you have a responsibility of 3 people that are dependent on you. You can't afford to take those risks. It's like an 80-year-old telling me, don't worry, I love bungee jumping, I'm going to bungee jump. I can't allow an 80-year-old to bungee jump. So a good financial advisor will give you an instrument which allows, which takes into your account your risk tolerance, right? Like, what is your inner makeup of risk? Like, are you willing to take risk? And two, can you take risk given your situation, your financial health, your dependence, your status in life and everything. So that you must understand your risk appetite, and a good financial advisor, and eventually even actually on our our app, we're going to have that, digitally you can assess that. After that, the advisor will plan your asset allocation. We'll talk a little bit about that. How much should go into an equity mutual fund, and how much should go into debt mutual fund, how much should go into gold, how much should go into international equities or international debt funds, which are also available now to you. So that all your financial advisor or a good robo-advisor will do for you. And then, of course, you must evaluate your plans periodically. Oh my God, has equity gone up like crazy? Oof, wow, you've made so much money. But guess what? Equity won't stay up forever. So maybe you should take a little bit of your profits right now, move them to fixed income, and then remove them to equity, etc. You need a financial advisor to help you through that. And once you are on this flywheel of being disciplined about your investments, don't stop. Next slide, please. And guess what, ladies? Your man is not your financial plan. So don't say, don't worry, I'm going to marry a rich husband. My husband has all the money. I don't have to care. He'll manage my money. My father managed my money. No. We don't know what happens tomorrow. So it's your money. You manage it. You take charge. You're responsible. Next slide, please. And so now it comes to, so you've decided, what your needs are. You kind of know your wants. You've put some money away for insurance, as we have discussed. Term insurance if people are dependent on you, and health insurance for sure, no matter what. Okay, everyone is going to put some money in health insurance. And guess what? DSP doesn't have health insurance, so I'm not saying it because of DSP. I'm telling you from personal experience. Every month a little bit for health insurance. So after all that is over, and we have some money to invest, we must, because we need to beat inflation. And where do you invest? Bank deposits. Now, bank deposits, if they're less than inflation, please no. And remember, bank deposits, guys, you are paying full tax. So depending on your tax bracket, you're paying tax on any interest you make, full tax. PPF, of course, depends on your employer, etc. If you're getting that. Should we put it in property? Well, if you have enough money and you need something to stay in, we all want to live in our own house. I want to live in my own house. I don't want to live in a rented house forever. So sure, but do you want to put money in property so that you can get rent from that? And that should be your income? Well, think again, guys, because you are paying full tax on that rent that you're getting. You have to find a broker to buy you the property. You have to pay brokerage commission on that. No one takes all that into account. You have to pay tax, stamp duty on that. And after you get it in your possession, you have to do it up. Then you have to find a tenant. Then you find a tenant and you have to maintain the property for the tenant. You have to make sure the tenant doesn't squat on your property. So you need to get a lawyer there. It's a hassle. Decide if you want to do it. And besides, real estate has not gone through the best time recently. But if you want to live in a property and you're going to stay in it, you're going to enjoy it, please by all means buy a property. But I don't know whether I'll think of it as an investment unless I'm in the real estate sector myself and I know enough. And then, of course, there are mutual funds and the individual stocks. Which one should you do? Well, Have you studied the individual stocks? Do you know the companies that you want to invest in? Do you know them backwards and forwards? Do you know that the person that you're investing with, is not going to take you for a ride? Do you know for sure that the balance sheet is strong? Do you know that, this company is in a strong sector? Have you studied it? If you're not an expert, then why not leave it to the experts? That's where we come to mutual funds. And mutual funds are of all sorts, right? You have equity mutual funds, you have fixed income mutual funds. So equities invest in a basket of stocks. So what is a mutual fund? An equity mutual fund is a mutual fund that invests in many, many, many stocks, right? Many stocks, I mean, usually there are about 50 to 60 stocks. Usually more than that, it's not a good thing usually to invest also, because it's too many stocks for a fund manager to handle. But usually it's like, 25 to 50 stocks is very manageable for a good fund manager. And, it diversifies your risk. So if one sector is not doing well, like right now, autos are not doing well, right? No one's buying autos. No one's really on the road. But what is doing well? Like Amazon is doing well. Consumer goods are doing well. Sanitation products are doing well. Everyone's right now running around buying hand sanitizer. So let the expert decide where the money has to be invested. And they will get a whole bunch of stocks together, and they will trade in and out as they feel necessary. And they will usually buy a stock which they think that will go up in 5, 7, 8 years, because they like the person running the company, they like the company, they like the sector, they feel this company is a leader. There are many reasons a fund manager decides to buy. So it's better the experts do it. It's better that there are many stocks than one stock. And by the way, in mutual funds, in equity mutual funds, if you make any money, so if you buy a mutual fund and sell it tomorrow and you make a profit of 100 rupees, you only pay 10% of tax on that 100 rupees that you make. So actually it's the most efficient where tax is concerned. That's basically what you should know about it. There is also something called fixed income mutual funds, which invest in debt instruments. So like fixed deposits of corporates, we've heard that, right? You have fixed deposits in a bank and then fixed deposits in a corporate. Well, how do you know which corporate is going to give you good fixed deposit? Is that a good interest rate they're giving? Are they going to actually return your money? I think, again, let the experts decide. The experts do make mistakes. So what they do is that they put it into many different bonds, therefore, and many different fixed deposits for you. They also lend some money on your behalf to the government in what they call government securities. So you have to let the experts just take a basket of those and you invest accordingly. So that, of course, bonds and fixed income mutual funds, they don't go up too much, but they don't go down that much either. They are relatively steady. They do go down sometimes. Sometimes in the short term, you can lose money. But if you keep them also for 2-3 years, you won't lose money. Usually, there are some that are more risky even within fixed income funds. In an equity fund, look at this year. You could lose 40%. Suddenly you put money one day and you're down, 30% in 15 days, as we saw in March. And then again, you're up another like 30-40%. So, it goes up and down. It's a roller coaster, and you need to have a good risk appetite. And maybe you can put some money there. You need a balance of it all. Can we go to the next page? And of course, there is gold. And look what has happened in the last year, as I said. So if someone had invested just last year, so last August, so it's, if you read at the bottom, it's just 1 year from August 28th. So it's 28th of August 2019 for 1 year. You only made 0.2% if you invested in the Sensex, which is what we call the market. And I'll explain that later, in the equity market. If you had put something in PPF, you were getting a steady 7.1%. Fixed deposits were giving you 5.3 over 1 year. Of course, today they're giving much less. If today for 1 year in the future. Your savings account is giving 2.7%. And gold has given 58.7%. Yes, gold. And most of you all have jewelry, so maybe we're good already. And 5 years, so if you look 5 years, equity market on average gave you 7.3%, PPF was 7.7, your fixed deposits is 6.5, your savings is the worst of them, just leaving it in the savings account at 3.6, and gold gave 13.8. But most of those, that 13.8, because I told you it's an average, has come in the last year. The slide would look very different and may again look very different next year. In 15 years, again, gold has done very well at 15%. Your equity markets are at 12%. And over 20 years, your equity markets actually gave 25%, and gold was giving about 28%. Again, it's very skewed because of look what's happened in the last 1 year. And yes, people are rushing to buy gold. Why is that? It's because they feel safer. They feel it's something tangible. But actually, what does gold do? What does gold buy? So it's one of these things that just makes us feel safe. The only thing it can do is really make jewelry for us today. There's no other use for gold. And so, we have to think about it like that. But of course, you can invest in gold, buy the jewelry. But the thing is, if you buy jewelry, you don't know whether it's going to be pure enough, right? We never know till we go to melt it. Plus, it's not easy to just sell, melt, get your cash. I mean, it is. But it's not as easy as buying a share online. You still have to go physically, sell it, figure it out, trust the person, who's going to sell it for you, understand the purity of it, etc. Another way to invest in gold, as people are doing, is sovereign bonds. So the government issues, bonds on behalf of the gold price, and actually those are even tax efficient. And you get 2% of interest every year, but given today's inflation, that interest should be like, you shouldn't bother. But if you keep it for 7 years, you even get the appreciation of the gold. If gold appreciates in 7 years, given the prices that are already so high today. So these are different ways. You can go and buy a gold ETF, which is like it's traded on the exchange. It's like a stock, gold that is traded, just easy to buy and sell. If you want to play the gold price, you can buy a gold mining fund. So stocks of companies that actually mine the gold. And as the gold price goes up, even their worth goes up. So, these are different ways to buy gold. But should you today buy gold when it's up like this? Please remember one thing, and I'll tell you again, don't chase returns. Always put money in the product that has not done so well. Never ever chase returns, because you will be disappointed. Will it go up further? It may. It may go up for another year. When people are scared, they run to gold. If the vaccine doesn't come out, if there's something negative on the vaccine, if it takes a while for the vaccine, to be given to everyone, gold may still go up. But once that happens, and once people get some security, will gold continue to go up? I don't know. It's not happened. So we have to be careful in that. But this is just how it goes. Now, when I say investing in the market, what does that mean? How many of us know what it means investing in the market? The market in India is called the Sensex or the Nifty 50. What does that mean? The BSE Sensex means the top 30 stocks by value that are traded in the market. So that's the Sensex. And Nifty is the top 50 stocks. So today I say, the market was up. Normally we refer to the BSE 30 stocks. Were those 30 stocks up on average, or were they down on average? You can do well. One stock can do really well in a market, even if the market is down, but your stock is up, because those 30 stocks on average are down, but the stock that you've chosen is up. It could be part of the 30 or it could not. So just remember that when we say the market, it means a basket of stocks. When I say the American market is up, we normally mean the S&P 500, which is their top 500 companies are up or down on average. Again, within those 500, you could have some up and some are down. So on average, is it up or down? So just remember, that's what we mean when we say the market is up or down. Can we go to the next slide? This is gold prices, guys. Abha told me to talk a little more about gold because, women want to know, etc. So, guys, just look what happened to gold from Jan 1920. This is 100 years of, gold prices. 100 years of gold prices. So look at Jan 20 so that's 1920 to 1972, 52 years, gold didn't really move that much, a little bit. And then suddenly it has gotten an upward swing. It's also scarce commodity, right? The more you mine it out and the more everyone has it, the less there is in the ground. So do remember that, yes, it has had 50 years of being flat. We don't know if those 50 years will come back again. But historically, usually in those 100 years, actually I should have plotted the equity chart, which has done much better than gold. Can we go to the next? And this is your Sensex. Remember I explained the Sensex, the top 30 stocks. These 30 stocks keep changing. The same 30 stocks in 1980 are not the same 30 stocks today. So the top 30 stocks at that point, how has the market done? Please see, the market has gone up, but it has had ups and downs. I remember I was in school when this Harshad Mehta scam happened. Suddenly the market went up, then it went down and everyone cried, the market is down, the market is down. Today it looks tiny, guys. Just look, you see that where it says Harshad Mehta scam, scam, it's tiny where it has gone down now. Just look, it's like a tiny little blip. Again, if you see in 99, 2000, it went up, because of the tech boom, and then it came all the way down, and today it looks tiny. We're all the way up here, and of course it's come down because of coronavirus and it's gone back up again. So this is what's going to happen if you plan to put money in the market. It's going to go up, it's going to go down, it's going to go up, it's going to go down. You're going to have palpitations when it goes down, and then you'll be relieved when it goes up. But if you stayed from 1980 to now, the market has only gone up. From zero, because it's the Sensex, you can say we've just backdated it, but it started around 90. I think it started around 82, but say if you backdated in 1980 and it's zero, today it's at, it had touched 40,000. So, it's 40,000 times from when it started. So your 1 rupee has become 40,000 rupees. Your 1 lakh has become, multiply that by 40,000. So that's really the way the Sensex has moved. But you have to have a lot of strength to be able to go through this. Next. So how can mutual funds help? So I told you, mutual funds are just, you let the experts do the work for you. They have a tax benefit. They also have SEBI, which is the Security and Exchange Board of India. It's like a police that sits on their head to make sure that the investors are getting the best and that investors are not getting cheated in any way. So there are lots of compliance and rules that come into mutual funds. Of course, mistakes may happen. Investors may make mistakes, but the market is constantly improving and evolving on the side of the investors. So now, which fund should I invest in? It all depends on your time horizon. Depends on your risk appetite, and it depends on your mindset, right? Your risk tolerance that we talked about. So if I have a short-term goal, which means, listen, I can only invest this money for 6 months, because in 6 months I'm going to need it. But, we don't want to put money in the savings fund because we know that savings bank account was giving you even less than inflation. So where should I put it? So then we would suggest you put it in something called money market and liquid funds that invest in bonds of companies or the government, but for only 2 months, 3 months. They give very, very, very short-term investments. So, they know that within 2 months, chances, we'll get our money back and, we'll get this decent rate of return. So it's much less riskier. If someone says, lend me money for 10 years, you don't know what's going to happen to the person in 10 years, whether they are going to be alive, whether they're going to return your money or not. But in 2 months, the probability is higher, which is why your risk is lower, but your return will also be lower. Your interest rate will be a little lower. But if it's for 6 months, you need the money back, it's better that you give it to instruments like money market and liquid funds that invest in very, very short-term debt paper. If you want to invest, for 1 to 6 years, You can invest in debt mutual funds. You can invest in what is called a balanced fund, which puts a little bit in debt, a little bit in equity. What is a medium-term goal would be if you want to go on vacation 3-4 years later, you're just investing for that. You want to buy a bag, you want to buy earrings, doesn't matter, no one should judge you. But these are your medium-term goals from 1 to 6 years. We would suggest debt funds or something called hybrid funds, which is a mix of debt and equity. That's not written here, but I would suggest that. And I would also suggest what is called dynamic asset allocation funds that keep moving into debt and equity according to what's going on in the market. The last is if you have a horizon for more than, I would say, 7 years, 6, 7, 10 years, listen, this little part of my money, which I'm not going to need for 10 years, or I want to invest to give to my children as, their inheritance. So I'm investing for their education, and the child is so small, for 20 years, I don't need the money. Then you please put it in equity funds, because it'll go up and down, but in the long run, we have seen the equity markets always recover if you have a good fund manager who choose the right stocks. Next. I think, I don't know how we're doing on time, but maybe we can just go to the next slide. It's a good slide, but again, people ask, like, how do you invest? There's something called an SIP. So SIP is, it's automatic investing from your bank account, X amount. So you say, I want to invest 10,000 rupees a month, 20,000 rupees a month. It'll just keep taking from your salary every month. You put your salary in the bank automatically puts it into a mutual fund of your choice, debt or equity or a hybrid, a mix of them. You decide that with your financial advisor. The reason it's good is because it's discipline. You won't spend the money. It's going into investing. It also, we don't know if the market is going to go up or down tomorrow. So every month, if you put it, it'll average your costs. So today it'll be up, tomorrow it'll be down, day after it'll be up. So your cost gets averaged in the amount you're investing. And so finally, when it really goes up, you get the benefit of an average cost, because I can't tell you the market's definitely going to go up tomorrow or the market's definitely going to go down tomorrow. So they call that rupee cost averaging. And it gives you some discipline to just constantly invest and not end up spending it. So that is what is called a systematic investment plan. A systematic transfer plan is, hey, I have the money now. I don't have to depend on my salary to get the money every month. I have some money now, but I don't want to put it all together. So, why not put it in a liquid fund where I'll get some money, and every month it'll go into an equity fund. So that's a STP, which is a systematic transfer plan. So instead of that money going systematically from your bank account into the fund of your choice, it goes from your liquid fund or any other fund to the fund of your choice in a systematic way, every month, every week, every day, whatever you decide. And then there's just some jargon. SWP is, you tell me, hey, after 15 years, I'll have saved enough money. Yes. Can I just withdraw money every month? Just the way I invested money every month, can I just withdraw money every month? Only the amount I need for my expenses, so the other amount is properly invested continuously. That is called systematic withdrawal plan. It will keep systematically coming back to your bank account every month, the same amount, or every week, or whatever you decide. A lump sum investment means you put it all at once. Can we go to the next slide? So guys, coming to the people who are truly, have a salary and are dependent on their salary, well, one day you won't have a salary when you retire. You'll have a zero salary life. And that is another big reason we all need to think of investments, because when we have that zero salary life, it's going to get really hard. You don't want to be dependent on your kids. You don't want to be, you want to still lead the same lifestyle that you have today. Why should you have to compromise? Why should you not be able to travel when you finally have the time to travel? So you don't want to compromise on your lifestyle, which is why you need to start saving now for the day you have the zero salary life. Can you go to the next slide? Abha, how are we on time?
We have time. We have about 15 minutes, but we also have a couple of questions. So whenever you're ready.
No, so do I have 15 minutes after this for questions?
We can go. I mean, no, we have about 15 minutes before we wrap.
Okay, guys. Then I mean, I can go. This slide basically tells you that the earlier you start investing for retirement, the less you need to invest for retirement. Let's skip the next. Let's skip this one and the next one. Next, yeah. Can we go to the next slide? Next slide. Another term in mutual funds that you will hear is ELSS, which is the tax saving fund. These funds are funds that, again, everyone must have. So do your first SIP into this fund, because if you invest, you are allowed to invest up to 1.5 lakhs a year into this fund. And in that 1.5 lakhs that you invest in the fund, you don't have to pay the income tax that you need to pay in your salary. So if your salary is, say, if your salary is, 10 lakhs a year, and out of that 1.5 lakhs you invest into this fund, then you're only paying tax on 8.5 lakhs, not on full 10 lakhs. So these are little ways that you have to invest. But remember, when you invest in this fund, it has to stay for 3 years. It's a full lock-in period for 3 years. Can we go to the next? So, how do you be a good investor, right, at the end of this? Definitely don't only go for equity funds or only go for debt funds. You need a mix of debt and equity funds, and maybe even hybrid funds, which itself are a mix of debt and equity funds. So I know we've gone really fast, Abha, like a real investment class. I need like 4 hours with this group or something. But these are the basics. You make sure that your investment advisor puts you in a basket of debt and equity, please. Of course, it depends on your risk appetite. It depends on your risk tolerance that we've talked about, and your risk-taking ability, that how much should be in debt and how much should be in equity, but you have to have a bit of, a little bit of everything. Do plan for emergencies. Some of your money must be in liquid funds, and I'm saying liquid funds over savings account because you're going to get a little more money in a liquid fund. And definitely have that, because tomorrow you don't know suddenly when you need the money, health issues, whatever, you just don't know. You need some money for emergency. Invest in equity funds, which can help you build wealth only if you don't need it for over 8 years. We had said 6 years earlier, 6, 7, 8, I would say 8 and above, that this amount of money I don't need for 8 years, only then invest in equity, because it'll keep going up and down and fluctuating. But after 8 years, on average, the chances of you making zero return are zero usually. So, and that's what we've seen historically in the Indian market. So if you have time horizon over 8 years, invest in equity. And in the meanwhile, if equity fund falls, don't get scared and panic redeem, because you know that your goal is 8 years, and keep it there for 8 years. Invest only if you can stomach a fall of 50% of total amount in equity, because we saw that in 2008 when the market fell like 50% almost, and some people panic redeemed at 50%, but that's a notional loss. It was a paper loss, because then it recovered. So why should you have to take the paper loss? It's going to, in the long run, it does recover. So if you can stomach the fall of 50% of that portion that you put in equity, put that in your mind, keep your expectations, and then only invest in equity funds. Know that in the long run, they will go up, but in the short run, they will fluctuate. It's the basic principle of a market. The market will fluctuate. And only invest in equity if you have patience and you have a calm mindset. Otherwise, it's going to be, like torture for you. And if you are invested in equity and the market falls and you're doing an SIP, you have an investment, be bold enough to put some more money. And if it falls more, put some more money. And actually an SIP does that for you anyway, because if you're constantly buying every month, even if the market is falling, it's constantly putting money for you in spite of the market falling. So it's buying for you at the right time. Otherwise you won't be able to do it. I'll give you an example. When the market fell in March, So around March 15th, it was pretty down. And I told my financial advisors, I want to start a STP, which means I have some money already in liquid fund. Every week, I'll keep putting it into the equity markets because I don't know how much more it will fall. But I know that systematically, keep buying when it falls. But I don't know when the bottom is. I'm not some soothsayer to do that. And I did that. And thank God I did that, because when the market fell like crazy, 3-4 days in a row, and March 23rd, when it was the lowest, I would not have had the guts to put any more money. But I was just happy that I had this systematically doing it for me, so I didn't have to worry about it. But if I had to make the decision myself, no chance. So it really helps you with your emotions. What I should have done is even increased more of the money when the market was going down, but that's a bit scary to do. I wish I can follow my own advice and actually even do that one day. And what are the don'ts? Don't only have one fund and then say, I had a bad experience, or I've done so well. One fund if you do well, it's a fluke, and if you do badly, it's bad luck. So don't only have one fund in your basket. Don't invest in equity funds for a short period. Less than 8 years in your mind. Even chances are you may do well. Next year the market may rally 20-30%, and you've only invested for 1 year and you're up 30%, you're like really excited. But that may not happen. And I don't want to give you guys false hopes. So you get your expectations right, that I'm going to be here for 8 years, and on average I'll do well. Don't sell when the market is down. Even if you need the money, try not to sell when the market is down. Sell in an uptick. We don't like to sell in an uptick because why do we not sell in an uptick? We don't sell in an uptick because we have FOMO. We think it's going to rise more. Be disciplined. If you need the money, sell in an uptick. Keep balancing between debt and equity, and that your fund manager will tell you again. That's a different lesson. And don't chase returns just because this fund has done well. I want to put money in that. But it's done well. No, it's finished doing well. How do I know it's going to continue doing well? That was the past. Gold is up 58%, so now I only want to buy gold. We don't know if gold is going to do 58% again next year. So we can't chase returns. We have to realize that it's happened now. Find the next thing that will do well in the future. So have a basket, because we don't know what's going to do well. Little debt, little equity, little gold. Part of them will do well, and on average we'll do fine. Next. I wish we didn't have this on the screen. I don't know if we can get rid of the scribbles. Ruchita, can we get rid of the scribbles?
I'm just checking. Not sure how that's happening.
You may have, since you have the...
No, I'm not really touching my mouse at all.
Touching the mouse? Okay. Sorry, guys. I will continue. Oh, great. Okay, great. Yeah, erasing them.
Yeah.
How do you get started? Well, I'm just showing you my app, but it doesn't mean you invest in DSP. You can invest wherever. But there are apps that you can get started. First thing you need to do is a KYC. I would say first get yourself a financial advisor. If you're really confident, you can go online. My site, or they have Scriptbox and they have ET Money, and you can go online. There are many sites to help you. You can do your KYC online. If you get yourself a physical financial advisor, which is what I'd advise you to do, they'll help you with your KYC. You'll need your ID and address proof and a photograph, and you'll also need now a checkbook leaflet, or like a cancel check. And then you should decide again. KYC you have to do with or with an advisor. Decide whether you want to go on your own or you want an advisor. If you go on your own, the expense is a little less, but it's better to pay a little more of that expense and go with an advisor so that you're guided. You can decide whether you want to go online or you want to fill in a physical form. I would say stay away from anything physical. Try to do as much online as possible. It's just easier to keep track. Next. And then we have a learn site, guys, dspim.com/learn. You can say you're a beginner investor or intermediate or an advanced investor. They have modules. I have, videos. You guys can learn there. Definitely, I would highly, highly recommend that you go there and you start. DSPIM.com/learn, or even if you download my app, the DSP app on the DSP Mutual Fund app, they have the Learn site on that app. Can we go down? Next. And we, by the way, have a Winvestor page on Instagram as well. And that gives you a lot of little tips on investments and how you should think about them. So do follow us.
Okay, Aditi.
That's the end, yes. And by the way, own your money. Okay, let's take charge. Let's decide to take control and let's own our money.
No, that's fantastic. We've got a couple of questions.
Sure.
And if we can see Aditi, then that'll be great. Someone's asking that, let's say if they have $100, what's the ideal proportion of investments, like lump sum investments, across different asset classes? What would you suggest?
So first, as I said, you need to do your risk profiling. Okay, you need to know, there are questions that will be asked. One is, how many people are dependent on you? Right? If a lot of people are dependent on you, well, that's a certain, you'll get a certain grade. Then two, you have to realize, are you okay with, a huge fall in the market? What is your risk-taking ability? Are you, or your risk-taking, your tolerance for risk? So you have to assess all that. Once you assess that, then you can also see if there's a goal in life that you're saving for. Are you saving for something in 2 years? How much money will you need in a short period of time? Once all of that is assessed, then I can tell you what your asset allocation is. And it's different for everyone. It's different for me. It'll be different for Abha. It'll be different for Sandeep. It'll be different, depending on your life situation at that point and your temperament.
Okay, Nikita is also asking if you could share a little bit more on index funds, and she's confused as to whether they're SIPs and exactly.
No. So index funds. Remember I told you what the market is. Remember I explained to that the top 30 stocks are market. So in Nifty, the market is. If I say the market is up, the Nifty is up, means the top 50 stocks on average are up. Those top 50 stocks are called an index. It's called the Nifty index. The top 30 stocks is called the BSE Sensex. That is also an index. Okay, so these are two different index. S&P 500 is the top 500 companies of America. That is an index. Now, what is a fund? A fund is will only invest in these top 30 stocks or these top 500 stocks or these top 50 stocks. And those are index funds that just mirror the index. Just take the top 500, take the top 30, take the top 50 stocks. Those are called index funds. Now, the fund manager doesn't have to select and use his brain. He just takes the top 30 by market cap. So that is what is called an index fund, where it is completely mechanical. And, the fee is very low. The fee is only like the fee to actually make that fund, no? Because there's some cost that goes into actually buying stocks, putting them together, giving them to you. It's a service. So that is what is called an index fund. So you can buy that if you like. But what is the fund? Why do you invest into a mutual fund? A mutual fund needs to beat the index. If they don't beat the index, then why should I pay the mutual fund the extra? I just go and buy this index fund. It's like it's a easy thing to do, top 30, top 50. That's why people have to beat, a good mutual fund manager has to beat the index. It doesn't beat it every year, but over a long period of time, has to beat the index, and that is extremely important. Otherwise, you should not be paying that sort of fee to the fund manager. The amount he beats the index by, so the index is up 15% and the manager is up 17%, that is called 2% extra, is called alpha. Okay, that is the lingo in our language. Fund manager must always have alpha. And you can't compare a fund manager who's investing in small cap, in smaller companies to people who are investing in larger companies. So you have to also compare the right index to the right fund manager.
Okay, and just to
and it's different from SIP, because SIP is how much you systematically put into any of these funds. You can put an index fund, you can put it into an actively managed fund with a fund manager that is not an index.
And just finally, while given what's happening right now in the world, it seems that equities are the asset class that everyone wants to be in. On the other hand, there still is a lot of fear and apprehension associated with investing in the markets. Naturally, I mean, look at what happened today, for example, even if it's just a blip. But every time people see red on the screen, there's just so much nervousness. So there was a comment right in the beginning saying that the reason we don't have confidence is because we're not making money, and that's a deeper conversation with that person as to perhaps where they're invested in. But how do you, and I know you've talked about SIPs, but anything else that you can share which will just help people understand why it's still important to invest? I mean, if we take a look at gold or the value of an Apple stock today, or even Jio or Reliance today, I mean, if you had invested even like 8-10 years ago, you'd be a really, really wealthy person. On the back of your...
I'll tell you something. The reason we don't make money is because of us. Okay, we have a fund called the DSP Equity Fund. That has been my longest, my longest fund with a track record of 23 years. It was our first fund, started in 97. This fund is up, Abba, you tell me, guess how much this fund is. So, if I put 1 lakh back in 97 in this fund, what should be worth today? Remember, it has gone through the .com boom and bust. It has gone through a very tough time in 2008. The markets were down by 30, 40, 50% in some cases. 40% I think is here. And then it has gone through COVID just. And what do you think that 1 lakh would be worth today?
I can only imagine the compounded growth that it's seen despite those falls.
Give a random number.
I have no idea. Tell me.
So it's up 49 times.
Wow.
50 times. So your 1 lakh is up 50 times in 23 years. Okay, India also went through a boom period. Okay, so it doesn't mean the next 20 years I can guarantee it's going to go up 50 times again. But it did go up. How many people actually got 50 times their money?
A lot of them would have dropped off along the way.
Less than 50 people.
Wow.
I have 30 lakh people today as my investors. Less than 50 people of those 30 lakh people got that advantage.
That's amazing. That's
us. We got scared. We got out when there was a .com bust. We got scared when there was, the financial crisis of 2008. We got scared during COVID. And then we say we don't make money. Well, it is our own temperament. There's a whole separate, I can do this for you, a whole separate presentation on behavioral biases. And the biases we have in our own mind that prevent us from doing the right thing for ourselves because of our anxieties. Yeah. And so it's very important. Also, remember what stops us from being anxious. I'll tell you, equity will make money in the long run.
Sure.
But what stops us is we're so anxious if we put all our money in equity. It's down 50%, I'll never recover. Therefore, you have to put some fixed income there. Therefore, you have to have some hybrid in there. Therefore, when the Indian equity market went down 37%, the US was down maybe 30%. You need to have maybe some international equities. Okay, so we need to make a very robust portfolio, and then you see, did my portfolio do well or not?
Yeah.
You see one stock, one mutual fund.
Yeah. Okay, I think
over a long period of time. Please, you all have to have patience with these things. 1 year, 2 years, even 4 years is not enough. So you need 10, 15 year patience to see.
No, and I also like the fact that you run through several reasons and several avenues of investing, as well as several reasons, how and why mutual funds should perform and what you should watch out for. Because I think the other aspect, while of course mutual funds have become the preferred way to invest for most people, I think for a lot of those that are still on the brink, it's a matter of trust, getting a better understanding that fund managers are actually involved in in monitoring those funds and making sure you get the best returns. So it's great to have had the presentation from you, and I hope everyone enjoyed it. They seem to have. We've got lots of very sort of positive
comments. I want to talk about two principles that we didn't talk about. One is compounding. And you mentioned that compounding, I wouldn't even know. So compounding means that the money earns money on the money that it has made. So your 100 rupees, say it's at 10%, you make 110, then you're making 10% on that 110. You're not making the 10% on the 100. It's not simple interest, it's compounding.
Yeah.
And then that keeps growing. It just keeps growing. It's like a snowball, they call it. They said that Warren Buffett, I was reading something, it was his birthday yesterday. He's 90 years old, by the way. And he's a billionaire, but he made most of his money after the age of 65. Because the compounding, the 100 becomes 110, 110 becomes 121. It's very slow in the beginning.
The last 20 years, yeah.
And then suddenly it goes up. Because if I tell you you're doubling your money, 1 rupee becomes 2, 2 becomes 4, 4 becomes 8, 8 becomes 16, 16 becomes 32, 32 becomes 64, 64 then becomes 128 suddenly.
Right.
Suddenly you get that, and 128 is suddenly going to different numbers and becomes 500, becomes 1000. It's like, but the beginning is very slow. Compounding is slow. And when Warren was asked, if what you do is so easy, and actually Jeff Bezos asked him, and your portfolio is out there, why doesn't everyone just copy you, and become rich? So he said, because no one wants to get rich slowly. Okay. And so compounding needs patience. You need patience. He made most of his money after the age of 65, and every expense he would say, should I spend so much money on a haircut? Because if I spend this money, the compounding effect of this money, if I'd saved it, would be $300,000 after 50 years. So the guy was constantly thinking compounding from the age of 11. And that's how he then ended up getting into this, picking the right stocks. Of course, the rate of return is important. And there's another thing called the rule of 72. What's all of the rule of 72? So if you take 72 and you divide by your return, so if you're getting 7%, 72 divided by 7 is around 10. So that is 10 years. 10 years for you to double your money at 7%. That is a rough rule.
Nice.
Okay, so if 10% is your return, it takes 7 years.
Yeah.
So 72 divided by 10 is 7. So it takes 7 years to double your money.
Yeah.
If
Got it. Yeah.
7%, it takes 10 years for you to double your money. So remember the rule of 72. Like, when do I double my money? Okay, nice. So just keep all these things in mind, and that is compounding.
Okay. One last question. Someone's asking, should we invest directly in IT stocks versus a mutual fund? Because IT stocks are up about 20% plus. Is that a safe way to go about it?
Well, guys, IT was different. Right now, IT is also different thing. IT services in India is the only thing you can play. Or actually, now you even have IT funds that invest abroad. Like, you can invest in the NASDAQ, which is essentially IT. You can invest in, there's some IT funds, I think Edelweiss has an IT fund out there, and stuff that invests abroad. So you decide, where you want to invest. Yes, they're up big time. These big guys keep growing bigger. I can't tell you that they're going to stop growing, but will they rocket the way they have in the last year again next year? I can't guarantee. And of course you should invest through a mutual fund, because you don't know which one will do well and which one will do badly. So it's better to have a basket and for someone else to take care of that.